When the law is confusing, two people benefit, and that is lawyers and loopholes. And this is exactly what KPMG is warning Nigeria about in the new Tax Act. But first, who is KPMG? I could just simply say they are financial doctors. KPMG is one of the biggest tax and audit firms in the world. So when they talk financial issues, we need to listen. So what they did is basically they reviewed the Nigerian New Tax Act and said something very serious. They say the law has errors, gaps, contradictions, and missing pieces that could cost Nigeria money, could also cause court cases and scare investors away. So now, let's break down what exactly they said or what they found. The first problem, as noticed, is who exactly can be taxed. So in section 3B and C of the Nigeria Tax Act, the law lists who government is allowed to tax. They say people, communities, organizations, and so on. But KPMG noticed something disturbing. Elsewhere in that same law, the word person is defined to include community. So this means villages, all producing communities, and communal landlords are all referred to as communities, and they are legally recognized as persons. But now, when the law listed who can be taxed, the word community disappeared. So a community is said to be legally in the law as a person, but a community again is not listed as a taxable person. So this creates legal loophole. And in Nigeria, of course, we know communities own land. They receive compensation. They receive all royalties. And of course, most communities, especially in the north, get mining payment. So if this is not fixed, this could lead to court cases, and that is why KPMG called it a drafting error. So let's move to the second problem. The second problem is foreign companies and foreign profit, according to section 17, subsection 3. So KPMG also raised a serious concern about how foreign companies are taxed under the new tax law. So what are foreign companies? Foreign companies are those companies that are not present in Nigeria, but they do businesses and profit from Nigeria. I would say Netflix, Google, Facebook, and the rest. So the companies make money from Nigeria, but they don't have their base here in Nigeria. And so what does the law say, or what was the law trying to say? So section 17, subsection 3 basically says that Nigeria can tax a foreign person if they have significant economic presence in Nigeria. So if a company has no office in Nigeria, but is doing serious business with Nigerians, Nigeria can tax it. Now, KPMG is not saying that this is wrong, but KPMG raised concerns how these companies should be taxed. And what did KPMG say? KPMG is arguing that the section 17, subsection 3 is connected to other parts of the law, and this is contradictory, or one will say it is broken. So here is the problem. So section 17, subsection 3b says that non-resident will pay tax through withholding tax, and that withholding tax will be the final tax. So final tax means that once Nigeria deducts the tax at source, that is the end. You don't need to file, no further assessment. But the Tax Administration Act, section 6, subsection 1 says these same foreigners must register for tax, file tax, submit account. So this contradicts the idea of final tax. So KPMG is saying, if the law says withholding tax is final, why are you still forcing these foreign companies to behave like they're fully registered Nigerian taxpayers? This creates confusion because if you get my tax before it gets to me, so why should I file for tax again if the money was already deducted? Of course, this will create confusion, especially in a bureaucratic system like Nigeria. So in simple terms, you already took the tax. Why force me to file again? That is what KPMG is saying. The third problem is foreign exchange and foreign expenses. So in section 20, subsection 4, the law says if a company spends money in dollars, pounds, or euros, the tax deduction must be calculated using the central bank official rate. Now, KPMG is saying that this ignores reality because most Nigerian businesses don't get dollars at official rates. So if I get dollar from the black market I'm expected to retire in the official CBN rates. The law will now force companies to pretend that they spend less than what they actually did, which means that they will pay more tax, and that is, of course, not fair. And that is not how a serious tax system works. The fourth problem is losses and capital losses. So in Section 27, KPMG raised concerns about how losses are treated. For now, so if a business sells something at a loss, say I bought a piece of land at 10 million and I sold it for 6 million, my loss is 4 million. In a fair tax system, that loss should reduce future tax. That is to say, if by next year I make a profit of 10 million, that 4 million loss should be deducted before my tax is being calculated. But KPMG is now saying that this new tax law is not clear on whether these losses are allowed to reduce taxable income. So if losses are ignored, businesses will be taxed on money they never actually made. And of course, that will kill struggling businesses. The fifth problem is rent and personal tax relief. So in Section 30, the law limits rent relief to 500,000 naira. KPMG says this is too small compared to today's rent. In most places in Nigeria, rent raises as much as 5 million to 20 million. So this means that workers will have to pay more tax even when their rent has exploded across Nigeria. And that is effectively a hidden tax increase on ordinary people. And so these are a few observations made by KPMG. And why this review matters is because KPMG is now a blogger, like we said. KPMG is one of the big four global tax and audit firms. So they advise multinationals, companies, government, and even central banks. So when they warn that a law has gaps, it is because they see how businesses actually operate and they know how courts interpret laws, and they also know where the money will leak out. So they've warned that if these errors are not fixed, this could scare investors and this could raise dispute, and Nigeria as well could lose revenue instead of gaining. As expected, the Nigerian government replied, but here is the truth. The government said most of these are not mistakes, that they are policy choices. And here's the problem. Policy does not replace bad drafting. A law must be clear, it must be precise, and it must be legally airtight. So if a word is missing, courts do not guess intentions, they read what is written. So when tax laws are vague, the rich will hire lawyers, small businesses will suffer, and of course, the loopholes will be the government. It is a truth at a time. Take care and have a nice day.